Hi everybody, good day. My name is Aman. I'm an investment coach and founder of Sage Investors, and welcome to another edition of Stock Talk, where we talk all things about stocks and investing and stock market and everything, finance, you name it, there we talk about it. Today I wanted to mind map or just kind of babble a little bit about something that's you're hearing a lot of these recently involving the concept of negative interest rates. Now, since early or mid last year, 2015, some countries in Europe have seen some of their yields on their government bonds go actually into negative territory, like charging a negative interest rate, like -1%. And recently, the Bank of Canada has kind of thrown out some trial balloons and saying, you know what, we might, at some point, may have to go there. And in the US, that's kind of in the Federal Reserve, that's a concept that's starting to gain a little bit of discussion. That's kind of in the more public domain, talking about negative interest rates. And last week was sort of a big moment in the Japanese central bank said they were going to adopt a negative interest rate policy. So what does that mean? Like for investors out there, what are the implications of having a negative interest rate policy? How's that going to impact generally how we do business, how companies do business, the overall economy, and ultimately for you and me, like our stocks, how is that going to drive stock prices? So I thought I'd just kind of try to mind map and walk our way through trying to rationalize what this is all about. So, the concept, let's just go back to first principles. So when you go to a bank, and let's say I have $100 I want to deposit in my bank account, my checking account or my savings account, I'm going to deposit it. And essentially I'm lending the bank money, and what they're going to do is take that money and invest it or lend it out to somebody else at a higher rate. And at the end of the day, the bank is going to give me my money back, $100, but they're going to give me a little bit extra to compensate for the fact that I've kind of had to part with my money. And that extra compensation is known as interest. And it's usually like if you deposit $100, the bank would give you, and charge 5%, they would give you $105. So that's the traditional way we look at interest rates. But now let's flip it around. Now we're talking about negative interest rates. So let's say I go to the bank and I deposit that same $100, and meanwhile the effective interest rate is -5%. So what that means is the bank is not going to give me $105 or $5 interest. They're going to charge me $5. So essentially, I'm going to deposit $100, and they're going to take $5 out of it, and they're going to keep it. And so at the end of the day, you have $95. So you're putting money in and getting less money out. That's what the whole premise of negative interest rates means. So the question is, why even do that? Like, why would we even go there? Well, the reality is, economies right now are pretty much flat. They're stagnant, they're mediocre, they're tepid, and central banks are trying to figure out ways to get people to spend money. To invest in products and services, investing in people, hiring people, building equipment, using technology. And so by adopting sort of a negative interest rate policy, basically you're forcing people to spend their money instead of save their money. They're just trying to get away people from saving and into spending and investing. So in the short run, that's a good thing, because if people are spending more money and you putting it to use, and companies are putting it to use, investing it into products and services that are going to generate hopefully future returns, that's good for profits and future profits, and ultimately that plays into stock prices. So that's kind of the theory behind it and the intentions behind it. And the other fact of it is, you're lowering interest rates, you're lowering your cost of capital. So your cost of capital is going to be even lower. So when you go out and value companies, they're going to be valued at a higher rate. So it's, but even at a negative rate, so it's even more exponential. So that's the intentions of it. So what's the reality of this? Does this make sense, or is this just like a really weird Seinfeld episode where everybody's in bizarro world? Reality is, in the short term, it's probably going to be, it probably will work. There will be a spike, and it's interesting, the stock market spiked like $400 after the Bank of Japan's announcement last Friday that they're going to do this. So there is a short-term benefit to doing this, but I think over time, people will spend more money, will be more motivated to not put money in the bank and use it, but the uses for it may not be really that beneficial. For example, the biggest one would be to invest money back into stocks, like going out buying stocks or buying other assets like real estate. But the reality is right now, even in its current form, stock prices, and that's what I've been saying, is stock prices I think are overpriced, and I think overvalued, and don't reflect economic fundamentals of the economic realities that companies are facing. And real estate prices, if you're living here in Toronto or Vancouver or London they're just through the roof. And I have a feeling that going to a negative interest rate policy is just going to encourage more people, especially more foreign investment, to get their money, especially in Japan. People are going to just money is just going to start flowing out of that country and into other assets around the world. And where the places are going to fall, they're going to fall into stocks and they're going to fall into real estate. So if you think the real estate market's really crazy and out of control right now, potentially it's probably going to be ridiculously out of control if foreign funds start looking for other places around the world to find yield. And this has been the dynamic for the last 5 years, and if we go to negative interest rates, it's probably going to be it could potentially be like even worse. It could be just ludicrous. And I guess the other side of it is potentially it could actually encourage people to just put more money, hoard more money, and instead of putting it in a bank where you're going to get have to pay the bank to deposit your money, people just like literally might just dig a hole in the ground in the backyard and drop all their cash in there, or just put their money in a safe. So that perspective, I think that's going to be a negative impact. And I think for me, even a bigger impact, and it goes back to what I was talking about, cost of capital and valuing risk. The fact that we've been living in such low interest rates for the last 5-6 years is just a reflection of how much people don't care about risk, and people are just looking for yield and returns and putting money into higher risky assets. So I have a feeling going to a negative rate environment, I'm thinking, is probably going to encourage people to take even more risk and put their money into assets that just they have no business putting their money into. So those are kind of the things. So the short-term benefits of going to a negative interest rate environment there might be some like a short-term spike, but I think long-term it speaks to just enhancing the issues that I think are still out there, and on top of it, just getting away from the concept of risk. Now, the other premise really of why central banks want to lower interest rates to have negative interest rates is they might be seeing deflation out there, and deflation means an era or a period of really falling prices. And from a stock investment perspective, that's not a thing you want to hear, because if stock prices of goods and services are perpetually falling, then as a consumer, you're saying, well, why do I want to pay $100 for this TV today when I know it's going to be $90 next week, and you're going to hold off your consumption? And so that whole concept of lowering interest rates into a negative territory is just, again, that spending stimulus, trying to get people to spend instead of parking their money in the bank where they're going to get charged for it. So it's something that we're going to have to really keep a close eye on how things evolve, and I'm going to keep a close eye on it because it really has some serious ramifications for really how our economies work and how we make our investment decisions. As I said, I think the market's crazy overvalued right now, and we've had this correction, but I think it's not enough. I think we need to see more. And but if we start going into like crazy, ludicrous interest rates, that's the gluttony might continue. So it's just a factor to really to keep aware of, and because I know I thought I'd talk about it because I hear a lot of people talking about like negative interest rates and really don't understand what that means. So hopefully got some insight into it. That's about it for today. If you have any questions, want me to talk about something specific or answer anything specific, you can give me a shout out to through Twitter, through my handle @SageInvestors, or you can hit me at my website www.sageinvestors.ca. That's it for Stock Talk. My name is Aman of Sage Investors, and happy investing. We'll catch you later.